Hello, everyone, and welcome to this month's Slice of Advice series brought to you by Journey Financial Services. My name is Paul. I'm one of the investment advisors and retirement planning specialists here at Journey, and I'm looking forward to presenting this topic to you. Unfortunately, it's been pretty rocky with the market, so I have a feeling that there's going to be quite a few people that are going to end up watching this. And it's one of those situations where we were sitting pretty there for quite a while. 2023 was really going up, and then 2024 was also great. Up until recently, it seemed like the fun was never going to end. But thanks to a couple of factors, we've seen a pretty decent pullback. And things are really looking a little bit uneasy and unsteady. So by the time we get done with this presentation, I'm hoping at the very least you'll be able to pick up a couple of good tools on how to help hedge your portfolio a little bit better, or at the very least have some new ways of thinking about and viewing your investment portfolio and giving you more confidence, peace of mind at the end of the day that you're in better situation than you think. So I've been mulling over this topic for a little while now, and I didn't want to necessarily bring up an analogy that everybody's heard before. Normally you hear the stock market's like a roller coaster, or escalator, elevator. I've heard all types of things, but none of them really fit. So finally, I kind of came up with this, and I think it's pretty spot on, where to me, investing in turbulent times is a lot like flying through turbulence. What started as really clear skies, a smooth and steady ride upward, can quickly turn turbulent, especially when you're taking this long flight up to and through retirement. The ride can suddenly get very bumpy, like it has been this March, and uncomfortable. You start to feel every unexpected shift a little bit more. The stakes are extremely high for many of you that are watching this. Your investment portfolio, it constitutes pretty much your entire life savings. And for those of you in retirement, it is your livelihood. So the more volatile the shifts start to happen when they're up and down, and the more you see these intraday major swings up and down. When you're on the flight, it's very similar. The more bumps, the more jarring, the more your concern grows. But for our clients currently, then you remember you've put your trust in experienced pilots, and the ones that personally, many of us personally, and then you remember that the vehicle that you're quote unquote flying in is one of the highest quality. We're using a vehicle that has an extremely long track record and of superior performance. And these experienced pilots don't panic. They trust their training, manage their emotions. They follow the flight plan and stay focused on the ultimate destination. These same principles, in my mind, apply to market volatility, economic shifts, all these political events, global. They're all stressors that may end up shaking things up, and it's almost like pretty much a certainty. It's death, taxes, and you're going to see your investment portfolio going up and down from time to time. If you think back, I can't think of a year where we didn't have some major uncertainty with one of these topics. So, but when you're flying through this journey through retirement, if you have the right strategy and mindset, you can stay on course, navigate through the turbulence, and if needed, move to a contingency plan with a lot more confidence and peace of mind. And ultimately, that's my goal for most of you who are watching at the end of today. Give you a few more tools in your backpack when you're investing your portfolio. And if we can help you increase your peace of mind or your confidence, even in these times where we're seeing major shifts up and down, then that'll be well worth you watching. So for me, the purpose of this presentation isn't to give you just another stock market or economic update on what's going on. We're already getting bombarded with all of these things daily, and it's really hard to cut through the noise sometimes. The first thing I would really like to help you all do is, my goal is to go a bit deeper, help recognize and understand the common behavioral biases that affect decision making, and understand what these are, what you're overlooking. And if we're able to do that, the next time you start seeing your portfolio dropping significantly, if you're able to take a step back and recognize why your first instinct is to fill in the blank, it's going to be different for everybody. Look at the big picture and really be able to identify, okay, what are the things that I'm commonly overlooking or not necessarily addressing, and that can be priceless, if for nothing else than to give you more peace of mind, confidence in what's going on with the market and your portfolios. For those of you who are currently clients, I mean, we still run into this time to time where somebody comes in and they're still unsure about what's happening with the market. And if I can help you take a step back, recognize why your first instinct is to fight or flight or whatever it is, and be able to give you some extra ways or different ways of thinking about what's going on with the portfolio, again, it's peace of mind, and that's priceless to me. Second major objective of this presentation is I want to be able to provide you with some real solutions, some tools. I think for a lot of you, that's exactly why you're tuning in. It's never fun if you're just looking at your portfolio balance in times like this and you're just watching it drop. So if you implement some of these strategies when the market's going down, we can help increase the downside protection, meaning that when the market's going down, your value isn't dropping near as quickly as the market, or in some cases you might be able to potentially even profit, off of what's going on, even when the majority of the stock market is going down. So finally, again, it's just, I hope to be able to provide our current clients with a guide, different ways of thinking about navigating the financial uncertainty. And for those of you who aren't, could be even more beneficial on what's really going on with your portfolios. So here at Journey Financial Services, we pride ourselves on trying to present things of substance to people. If you're taking the time to watch this, and then I want to be able to present some things that aren't commonly talked about, some truly new ways of looking at things, or new tools that you can implement in your portfolio that you can't necessarily get just off of the street. This first subject is definitely one of those where I never hear people talk about this. For whatever reason, when it comes to the investment and the finance world, we commonly seem to overlook the psychological side. Try to get to know every single client well, and then help them to be able to take a step back in these times that we're seeing significant drops in the market, and help them realize why they may be thinking the way they are. And if we can provide you with some tools that help you to take a step back and actually identify it and realize what things you may commonly be overlooking, that's priceless, in my opinion. So there's 4 major behavioral bias types that most people, you're going to fall into, maybe not perfectly into one, but by the time we get through these, I think everyone that's watching this will have one that they identify with the most. And so the first one is, we call it loss aversion, where an investor, they feel the pain of a loss significantly more than the pleasure of an equivalent gain. And to take it a step further, there's plenty of people out there that the pain of any loss overrides absolutely everything, where last thing they want to do is to see their portfolio negative at all. And it's understandable. The main thing that is overlooked by people that fall into this category is, yes, it's safe over the short term. That's completely correct. If somebody wants to invest their portfolio in just cash or bonds, it's definitely safer. But when we're looking at the person and we're not just trying to help you accomplish what your goals are over the short term, for most of you, you're either nearing or in retirement, at which point every move you make is a big deal when it comes to your long-term plan. And the biggest thing that I see with folks that fall into this category is, yes, you're safe right now. Short term, you're perfectly fine. But inflation's a real thing. I know everybody feels it. And over the long term, inflation really eats in to people's portfolios. And right now you're safe, but we're trying to help the person look 10, 20, 30 years into the future to make sure that they're not exposing themselves to having the chance of running out of money. And so the biggest thing with this category is, like I said, you're safe, but it puts most people in serious jeopardy of draining their investment portfolio over the long term. And the majority of the safe style of investments, they don't return a lot. So really, they're not even outpacing inflation. The second, we call it recency bias. It's disproportionately focusing on recent events, news, or performance of a particular type of investment when they're trying to make these decisions. Biggest thing they seem to overlook is the long-term trends, the actual historical data. And a lot of times they tend to not think too far ahead and realistically gauge the long-term viability of whatever investment they're in. The other big thing that people, if you feel like you may fall into this category, you really need to try to question, especially with the events and news portion, question where this info is coming from, what the source is trying to do. Whenever you see these doom and gloom articles when it comes to the market, oh, the sky is falling, if you get to the end, 9 times out of 10, they're trying to sell you gold or annuities or something, and the whole reasoning behind these extreme stories is to try to lead you into buying their product. And so that's a big common thing that I run into also, is clients will bring in some article from whatever source, and when I look it up, I see that the author is some institution trying to sell them something. So you really need to question that. The other big thing with the recency bias is people tend to underestimate the power of long-term compounding growth. These people will initially, maybe they'll stay diversified, but after a little while they'll start piling their portfolio into a couple specific things based off of whatever the recent events and news have been. And they're moving in and out of investments so often that they're missing out on a lot of long-term growth. So the third is herd mentality. I think everyone's heard of this, no pun intended. Tendency to follow the actions of the larger group. And often it leads to irrational decision making. They're extremely emotional and really are trading off of instinct rather than actual long-term data. So the big drawback and thing you have to consider that most don't, if you feel like you fall into this herd mentality group, is trying to take a step back. Normally, they will also shift their portfolio in extreme ways, completely selling out of something that was important and diversify their portfolio, but because NVIDIA has been up for the past 2 years, they'd rather just move into that, and it can really be dangerous. So that's the major things you have to kind of take a step back and consider if you feel like you fall into this group. Lastly, there isn't really a term for it, but it's so common that this is what I always call it, where we just call it return bias, growth bias, where whoever it is they're focusing way too much, again, on the short term, market fluctuations or a specific stock getting hot, and they miss out, one, on the long-term growth potential. They also are, in my opinion, probably one of the more dangerous biases because, again, like with the herd mentality, they'll end up shifting a large portion of their portfolio into whatever it is that's been performing really well. And again, normally by the time you get there, you may have already missed the boat. And what's ironic with this is that 2-3 years ago, we didn't really see a lot of people in the return bias category, simply because the market was not good at that time. But fast forward to today, the market's been doing pretty good up until recently. So suddenly all these people that were, I see it happen often with the loss aversion one, where originally they didn't want any loss at all, really safe, suddenly want to shift extremely into pretty much all growth stocks. And that can be catastrophic to a portfolio, no question. The other major thing that's overlooked with this return bias, if you feel like you fall into it, it falls in with the loss aversion portion, where anybody who's trying to chase the growth or follow the hot thing is usually, when they do that, they do not account for the risk at all. Where when a person was originally not wanting to lose really any money, and suddenly the market's been doing really well, so they want to shift the whole portfolio into growth stocks, they don't consider the downside and the danger that moving into growth has for people. And again, normally they tend to miss the boat. And if you suddenly start putting your money into all growth investments, as we've seen in the past month or so, you can take some major losses. And again, it can be somewhat catastrophic. Next up on the docket is really critical too. And from what I've seen for a lot of people, they're looking for solutions, which I understand. Some practical tools or investments that they can implement to help them navigate the storm, weather the major downturns. And so this is one of my more favorite subjects right here, where these are actual things that you can implement within your own portfolio. I think everybody's heard of the term hedge your bets. It's really common in the investment world. A hedge is an investment, either vehicle or asset class, that you will use to reduce the potential for loss in the overall portfolio, because, and this part's key, its price tends to move in the complete opposite direction. So when the stock market's going down, if you use a hedge, quote unquote, a lot of these types of strategies, they will go up. And I want to make sure that people understand hedging is not something you should ever do in your entire portfolio, ever. It's a degree of moving a portion, and it doesn't even necessarily have to be an extreme amount into these types of hedges. And again, when the market goes down, they go up. So it helps decrease the amount of losses that you'll see in the portfolio. Common thing is diversification. Everybody says it. You hear it all the time from everyone. But I don't know if people actually truly know the definition or how to practically implement it in your portfolio, where diversification is a strategy where you spread the money in your portfolio across multiple asset classes is the key, which I'll go into in just a minute, industries, and also geographies, to help reduce the risk of the downturns. So many of you have probably heard the term CYA. In our world, it means something different. It's cover your assets, which common asset classes, besides stocks, corporate or government bonds, Bonds are something that's pretty well known, where they're a debt instrument. You're essentially making an agreement with either the government or a corporation you're loaning them a certain amount of money, and they in turn are agreeing to pay you an interest rate, whatever that is, every year until at the end they're supposed to return your money back. Up until recently, bonds were always relatively safe, but whenever interest rates go up, that's the one time that bonds, you can start seeing some major issues, and the price actually goes down with stocks. It's very rare. It's only happened 1 or 2 times in the past 30 years, but it can happen. Next asset class is called commodities, which commonly known gold, silver, copper, energy, even things like wheat. What might not be as well known is nowadays within an investment portfolio, there's all sorts of things that you can invest in, and there's a lot of common funds that you can put your money in within your retirement account that track with the price of a certain commodity. So as of recently, gold is a big thing. It's not always guaranteed, but historically when the market goes down, the price of gold goes up. It's one of those inverse relationships again. So if you don't have exposure to some of these types of things, adding in a portion of your portfolio into bonds or commodities can be really valuable in times like these. Next commonly known one is real estate, whether that be physical real estate or in the investment world, they're called REITs, real estate investment trusts. They're, again, within your retirement account, we can find some funds that essentially invest the money into physical real estate, which is a decent diversifier, within your portfolio. Different market sectors, meaning within the stock market, they classify the market into multiple sectors. Like recently, technology has been extremely hot, communication services, even things like healthcare, consumer staples, those kind of sectors tend to do a little bit better or hold up better when the majority of the market's going down. Maybe blasphemy for some people. I tend to get mixed results whenever I mention something like this, but annuities, everybody's heard some bad stories about them. And the majority of the time when you see something negative happen with an annuity, it's with they call them variable ones. They're a type of an annuity that basically does the same thing as a stock market. If the market's down, you can lose money within it. The only types that we deal with are called fixed or fixed indexed, where they are fixed. If you invest a certain amount within them, you won't lose any of your principal. They usually are tied to some sort of index like the S&P 500, where they'll give you a portion of the growth every year. You'll never get an equivalent amount, not usually. But the nice thing with these is that within that year, if the S&P is down 20%, you don't lose any money, which for some people can be extremely valuable. The big thing to try to keep in mind with annuities also is that they have terms, anywhere from 3 to 5, 7, 10-year terms, where you agree to put your money with them, and you have to keep the majority of it in there for that duration. Another common thing that's got hot recently, again, CDs, money market accounts, cash, they are their own asset class. And if we had been doing this presentation 2 years ago, almost nobody had money in CDs. You could hardly find a CD for over 1%, where you fast forward to today, suddenly all of these safer type of investments, they're all paying out pretty decent interest right now. So this can also be a decent diversifier, especially when the market's going down. The main thing to keep in mind with the CDs is that, again, like the annuities, you're agreeing to put your money there for a certain time span. And with CDs and annuities, usually, if you try to pull an excessive amount of money out early, you're going to have to pay a penalty. One really recent development in the investment world is, we call them buffer ETFs, buffer investment funds. The vast majority of them, they've only been around for 3 or 4 years. They have a really short track record, which is why for a lot of people it just doesn't make sense. Typically we won't recommend an investment unless it has a long track record of success. But the reason why these have become popular in the past couple months is simply because these funds, the way that they're set up, they have a buffer, meaning they base the investment performance over a 1-year period. And if the buffer is, let's say, 20%, over that 1-year span, if the S&P is down 15%, you don't lose any money. If it's down over that 20% buffer, then you lose a portion, but you don't experience near the loss that you would if you just had it in the stock market. And they've become pretty popular. They do get kind of complicated, so it's one of those things. If you're thinking about considering them, you're welcome to come in and talk to us, and we can kind of give you the lowdown on everything. Pros and cons of hedging. The biggest thing, no matter what, is that you do not have a guarantee, even though these different types of hedges tend to go in the opposite direction. When the market's down, they go up. It's not a guarantee. There has been times in recent history where some of these asset classes have also gone down when the market goes down. But with most of these assets, if you properly diversify part of your portfolio among some of these, you're just ensuring with pretty high likelihood that when the market starts going down, at least part of your savings within your retirement accounts is still potentially going up. And that can be, again, pretty priceless. The biggest con, like I said, it's not guaranteed. And if somebody has questions about the proper amounts you need to use to hedge, that kind of thing, you're welcome to schedule an appointment with us. Different rules of thumb, but most of the time you definitely don't want to put more than 10-15% into any of these one specific types of hedges. The danger with all of these is it's not guaranteed, but also when the market ends up going up, after you buy most of these hedges, again, they move in the opposite direction. So if the market starts rebounding, then the majority of the time these hedges, they end up going down. Now that provided you some hopefully really valuable tools that you can implement within your portfolios if you choose to help navigate these times of major market uncertainty. Now we'll move on to the strategies. Disclaimer, this is something that if for those of the majority of our clients, we already are implementing these things within your portfolios. If you do have retirement accounts that are in the market, it's another one of those things that it's like the psychological, the behavioral portion. I don't hear many industry professionals talking about this that often, but it's something that's extremely valuable. Dynamic or tactical asset allocation, where it's more of an active strategy that we continually adjust. The key word here is a portion, not all, just a portion of the portfolios, the different asset classes that we talked about during the last slide. We can potentially shift some of the money assigned to the bucket A, is what most people know it as, within either the asset class itself or into another short or medium term asset class. And the whole goal behind doing this is when times like now are happening, where there is some major uncertainty politically, the economy, and the stock market's definitely been pretty rocky, we can actively adjust a portion into those hedging instruments that I talked about during the last slide. So an example of tactical rebalancing, it's again shifting a portion, not an extreme amount by any means, but a portion of your portfolio over the short term into the other asset class or within it. Again, we are just reducing it. We never want to sell out of something completely. It can be 9 times out of 10 pretty catastrophic, but if we're able to shift some of the funds around and invest in more of these active hedges, it can be a big deal. So some examples of this: from growth to value. We're talking about stocks right now. So up until recently, the market's been great. And it goes back into that last behavioral bias, the growth bias, where things are going great. People want to invest in some aggressive stocks. Not so great currently, but we can shift a portion of your growth stocks into the value sector, which are known as dividends. This has been extremely valuable for a lot of people. If we're proactive and are able to do it ahead of time, it can make all the difference in the world. For a lot of you that are clients currently, I have been doing this behind the scenes and ahead of time. Typically when the market starts seeing a major drop, the growth stocks, they go down hard. They start to drop significantly. Whereas in times like right now, where the market's going down, these value or dividend stocks are the more well-established companies, the ones that have been around for 30 or 40 years, that have a massive market cap and no debt. McDonald's, Johnson & Johnson, Pepsi, those types of companies, where typically when the market goes down, they hold their value extremely well, usually, to where growth may be down 10% over a couple months span. At that same point in time, these value stocks, sometimes they're even, or in some cases positive. So this is another really important strategy that you can implement, or we can help you. Another really important one is with stocks again, shifting from the smaller size companies into, again, these larger, the well-established dividend companies can make a really huge difference. Also, again, I want to make sure that we disclaim, if you're trying to do any of these strategies, we never want to shift the money from something that's down right now. So if you've got a particular asset class or types of stocks that are suddenly showing a decent loss, it isn't the time. Selling when you're down can be a big deal when it comes to most people's portfolios. But these smaller companies, when the market sees uncertainty, they're usually the ones that have even more volatile shifts, to where if the market's up, these smaller stocks typically go up even more, but when it goes down, same thing. And so shifting a portion of your equities is a smart idea. So another option is to shift from traditional equities, which are stocks, into, and this is one of those hedging classes that I talked about during the last slide, shifting a portion from stocks into commodity, which, like I said, gold, silver, copper, wheat, things like that. They typically have an inverse relationship, so that can be really valuable. From equities, which are stocks, again, into fixed indexed annuities, where it's not for everyone. I get it, but right now, if you're looking for principal protection or minimizing your losses completely, these fixed indexed annuities, they can be really valuable. You don't lose any of your principal. They base the gains off of a year's cycle, and if the market's up, they'll at least give you a portion of the growth, but if it's down, you don't lose any money. From U.S. equities, so we're shifting geographical regions now, which up until recently, for the past 15 years in a row, U.S. stocks have crushed international stocks in terms of their growth. It's been a long time, but as of earlier this year, things have shifted a little bit to where year to date, there are certain well-established European companies or European countries that are for once actually outpacing the U.S. market. And it's another one of those diversifiers where, again, shifting your stocks around a little bit into the international developed markets can be a decent strategy. For those of you in retirement that are our clients currently, we talk about it a lot. It's a whole different ballgame. We understand once you're in retirement, everybody's mindset tends to change, where for the longest time you've gotten guaranteed income coming in, and once you hit retirement, suddenly that's all gone. And so you look at your portfolio values a lot more often. And once people hit retirement, typically they tend to feel these drops a lot more. So when you're starting to pull money out of these retirement accounts, we call it strategic draws, where we can shift the money that we're pulling every month for your income from different accounts, from different parts of the portfolio. You know, we don't want to pull from stocks when they're down significantly. So in a well-diversified portfolio, when the market's down, we will start pulling the income that you need from the bonds, commodities, the more stable, safe asset classes. Always try to keep in mind the long-term plan. Whether or not we even tell you this, you know, for all of our clients, we have put together retirement plans or financial plans. And again, we're looking at the long term, where some people, you may need to have superior growth in order to make sure that you don't run out of money in retirement. Some of you, you have enough in the asset portfolio that you can afford to not take a lot of risk. But the key here is just trying to remember and refer back to your plan and realize that these instinct, quick moves, if you're thinking about making a major change, it can have a pretty significant impact on your long-term plan. So before you consider doing that, for our clients, we definitely want to be able to sit down and talk with us. Finally, you hear it all the time, you know, stay invested, stay invested, stay invested. And it is probably one of the most important parts of investing. I know a lot of times when people are told this, they're not really shown why. And so in another slide or two, I'll try and give you some real life examples of why it's critical to try to stay invested. Moving on from the physical tools and the strategies that you can implement in the portfolio, these are some helpful ways that I found as an advisor to try and help people think about their investment portfolio a little differently. And I've never seen anybody present it like this, but I feel like it's perfect. For the vast majority of you in retirement, you've saved up your money your entire life, and you've essentially dammed up whatever amount it is, and now you're pulling money out monthly for expenses, but we're trying to keep the water level on the dam as high as we possibly can. So from what I found, most people think about it and they view it like this overall. In these times of market volatility and some drops, if we fast forward a little while, suddenly people are just looking at your whatever the account balance is. And it is worrisome. I understand when you see your portfolio dropping, it's impossible not to be a little concerned. But what I'm trying to get across here is some ways to actually view the internal within your portfolio. I really hope that this helps some people in the long run. Every time I present this, I always have people come aside and tell me that this has really hit home with them. So if nothing else, if this can help some of you who are watching, give you some more peace of mind when it comes to how you view your portfolio, I'm happy. Where this is that same initial where you're looking at the portfolio balance, you know, the water line. But a beneficial way to look at this is that, you know, for our clients, there are many different layers that we built into your portfolio. It's not just everything is the same. So the bedrock of anyone's portfolio is the conservative portion, which is right here. For most of you, we've built in a moderate category, which again is somewhat conservative, but also has some growth potential. And then finally, the growth is the yellow part right here. For everybody, it's different. Some people might not have a lot of growth at all, but when we fast forward in time again, and same thing, the water level, your account values have dropped. I love showing it this way. So if you're comparing the two right now, the overall account balances of the portfolio are down. But in reality, if you look deeper beneath the surface, the conservative portion stayed almost exactly the same. So you've got your bedrock. The moderate dropped a little bit. And then if you really look at it this way, the biggest thing and really one of the only parts of this portfolio that has decreased is the growth. I think too often people, when they're looking at their account balances, they just look off of the balance. And when we get to this side where the market's coming down, they assume that every single thing within the portfolio is dropping at the same time. Where if it's constructed correctly, which I feel like we do very well, when you look at it, not everything is dropping at the same time. We still have your bedrock, really conservative, bonds, value stocks. The moderate is still pretty similar. It dropped a little bit. But again, in reality, the growth is the only portion that really had a significant drop. And so if you try to view it this way, where not everything is going down at the same time, we intentionally will build them out to where if your account value or the market starts dropping, usually these conservative and sometimes even moderate investments, they'll keep their value, or if you're hedging, may even go up. If you haven't guessed at this point, I'm pretty big on, I'm a visual person, so I want to be able to show you some things that will help illustrate the point instead of just listening to what I have to say. This is basically the 2020 COVID market correction that happened not that long ago. Two different people, and this will really hopefully help illustrate the never sell when you're down. Two different people, Jack and Jill, which Jack and Jill went up the hill to get a, yeah, I thought that was pretty good, so I had to use it. Both of them started at the same time with the same amount of money. Jill, who is the blue line, she stayed invested the entire time. So this line represents her portfolio. Jack ended up selling towards the bottom, which some people did. It happens, but those stories that you hear about people getting completely wiped out, whether it was the 08 market crash, all of that, I can almost promise you the vast majority of them, they sold at some point when it was down. it's extremely hard to make back up the losses, and in a lot of cases, it's catastrophic. So Jack, which is illustrated by this black line, it's not exact, but Jack sold out and waited 8 or 9 months to reinvest, where it's a common thing. We see it happen. If we fast forward to today, again, Jill is the blue line. Jack never was able to get quite back. The market's rocky. You can see, I mean, it never is linear. But if you're able to stay the course, stay invested the entire time, both of these were $1 million portfolios. Jill, at the end of it, ended up with close to double for her trouble. And Jack, just by selling and waiting 8 months, ended up barely over where he started. In the interest of time, I'm going to start going quicker, but I appreciate, hopefully, all of you that have been watching have found this valuable. This is the other tool that I found personally that tends to really help drive the point home with people. S&P 500, which is 500 biggest stocks in the market, over the course of about 20 years, if you miss and sell out at any given time, missing some of the top performing days, which in this situation, if you go back to the last one, usually the best performing days directly follow major drops. So this is over the course of 20 years, which equals about 7,000 days. If you stayed invested the entire time, you would have averaged over 10% per year, which is great. If you missed just the top 10 days out of the 7,000, you're almost halved, where 6%. And for those who, and this is what we see often, if you sell out, wait some time, usually you're going to miss out on many of the best performing days over the time period. And so if we get in the realm of this person missed the top 20 or top 30 days over 20 years, if you miss those, this really seems to help drive home the fact that, I mean, 1.3%, you might as well have been in cash the whole time. So we've covered some different strategies on how to think about or view your portfolio, psychological effects, and then some real tools that you can implement in the portfolio. It's been a lot of doom and gloom, obviously, which I hate, but now we're going to talk about some opportunities. When the market's seeing volatility or uncertainty and we're starting to see some major valleys, this may sound really foreign to some people. I remember it did to me the first time I heard it 15 years ago. I'll never forget it. One of my best friends, we were talking about the market and how horrible it was. And he was like, well, yeah, no, I love it. You know, I dropped more money in there. It's almost better when it goes down. And I'll never forget, in my mind, I'm thinking, what are you talking about? How are you, the market's down, so you put in more money? Like, it was shocking to me, but it's actually a pretty true statement, where all of these stocks, if we're in the times where we're dropping, and things are down. There are actually some pretty good growth opportunities where a lot of these high performing stocks, they may have been expensive at the time, but now if we fast forward and the market's down significantly, suddenly there's a lot of really quality assets out there that are now at a discount, much less than they were. So if you've got money or cash on the sidelines, this is a really good opportunity to buy some extremely great companies at a discount. For those of you with non-qualified accounts or after tax, we call it tax loss harvesting, which is selling and registering the losses within a non-qualified account and being able to save those indefinitely for the times when in future years, if you have a bunch of gains, you can offset a lot of the gains with losses that we've harvested from, it can be 10 years ago. You can carry forward your losses forever. And then the other interesting conversation is just Roth conversions right now. It just kind of goes back into the fact that there's a lot of great quality assets out there right now, even with the market dropping, that are much cheaper. If you do a Roth conversion, you're going to be able to buy a lot of really quality assets at a pretty steep discount. So hedging against your biggest concern, this is more of the peace of mind category and just giving you more confidence. Now that you have some of these extra tools that you can implement in your portfolio, that is a great opportunity right now. And whatever your concern is, I've heard all sorts of things, over the past 5 to 10 years, you wouldn't believe. But whatever your concern is currently, we can build out something. There's always a way to hedge, is I guess what I'm getting at. Where if you're worried about the political landscape, if you're worried about a major downturn or electricity becoming obsolete, I've heard everything. We can find something else in the portfolio that's a hedge that it might go up, it might do well, it might not, but if it helps give you the peace of mind that we're insulating you from whatever your biggest concerns are, that's priceless in my mind. So for those of you who are clients, you already have experienced it. For those who aren't, I would be more than happy to sit down and talk with you. Professional guidance over the long term, especially in these times with the market dropping, it's invaluable. We can help you insulate your portfolio to where we can help you create a long-term plan and really get into the nitty-gritty on what type of growth you need in order to not run out of money at the end of your life. There's countless things that we can do to help, but peace of mind, confidence in what's going on with the market. I know I've harped on it a lot, but in my mind, these two things are invaluable. You can't really even quantify it. For most of you, there's a reason why you hired us, and it's you don't want to spend every waking minute of the day worrying about what's currently going on with the market, or you're retired and you have things, you have things that you want to do. Either way, the peace of mind and confidence that you're in a good shape is priceless. And I talked about it a little bit earlier, having the plan in place to where if you've never had one done, it's critical, especially nearing retirement, where there's all sorts of people, some have saved up a lot of money and they're fine. There's some that don't have a lot and are cutting it close. That's pretty obvious, but there's a lot of situations that I've ran into where there's people with millions and millions of dollars in their portfolio right now, but they are actually in the most danger of running out of money within 10, 15 years. And it happens. So we try to build out a plan for you and really get an understanding of what kind of return do you need on your portfolio in order to not run out of money. That's most people's biggest concern right now. And so we can help with that. So bringing it all together, again, I appreciate the opportunity. Hopefully for those who have been watching, you've gotten some valuable things. One of the funniest things I've seen in a long time. The last thing we want ever is for our clients to come in, and I'm blocking part of this, but it says, and if I could point out your feelings according to the data here, I think you will see your feelings are incorrect. We want to be a sounding board. We want to be able to actually talk with our clients and collaborate. Everybody's fears are different. Some may be rational, some may not be, but if you're working with an advisor and you're trying to tell them what's going on or what you're concerned about, if this is all you're hearing, then you definitely should come talk to us. Again, it might be correct, it might not, but we can help you build out some hedges in your portfolio that can help insulate you against whatever your biggest fear is right now. And again, that goes into the peace of mind and confidence. That's priceless. So the key takeaways: avoid emotional investing. Hopefully at the start of this presentation, you can help recognize maybe which bias you fall into. And if it helps you, take a step back and really think about the things that you might be overlooking. That alone can make a huge difference. This is important. Returns are never linear. Never linear, meaning if you're in the stock market within your portfolio, they never just go straight up. And for any of you that's invested for a while, I think you know this, but I still run across this often where they just assume their portfolio's always going up. And the second it starts going down from the high point, then the world's ending. Market uncertainty is normal. If you really take a step and think in the past, I'm betting you there's not a single year in the past 20 years that there hasn't been some uncertainty or worry, whether it's politically, economically, or internationally with different conflicts. If any of you can think of a year in the past 20, 30 years, message me and you'll earn a prize if you can think of one. But to hedge or not to hedge, that is the question. If you're starting to get to the point where you're worried, I think hedging, it's a real tool. And again, it goes just back into the peace of mind or confidence in what the market's doing. Your portfolio may still go down. I mean, returns are never linear. But if we can help implement some hedging strategies, the different asset classes and things to help give you that peace of mind that whatever your biggest fear is, that we've got you covered, then you can't even quantify that. Stay informed, but stay rational. Obviously, really question the source of the news, like I talked about earlier. The opportunity side, uncertainty creates opportunities. There's a lot of assets out there right now that are they're getting to a point where they're undervalued. So money on the sideline, sometimes these drops are opportunity. Main things for those who are watching that are clients, if any of this speaks to you, or you haven't talked to us recently about what's going on with the market or your portfolio, we want you to come in. We can review your risk tolerance, make sure that it still falls in line with where you're at now. For those of you who aren't clients, this is also really critical. We can definitely sit down and talk about everything in terms of your portfolio, what the potential downside or losses are, what the growth opportunity is there, but more importantly, tie it fully into your financial plan and make sure that it falls in line with what your goals are. We always want opportunities to collaborate. This falls right back into what I was saying earlier. That's why we're here. If you have concerns about something, we want to talk about it. And there are always some hedges out there to help insulate against whatever your worry is. You just have to keep in mind that it's not guaranteed that if whatever your worry is happens, that it's going to mitigate the losses. But we're here to help. I appreciate the opportunity to be able to present this to everyone. You can tell I'm used to in-person meetings or virtual, but I hope you all enjoyed this and have found some value somewhere. If it helps give you some peace of mind or make you feel better about your portfolio, I'm hoping it's well worth it. This was this month's version of Slice of Advice. For those of you in the area, you're welcome to come to all of our future months' topics. We typically will do this presentation in person at Pizza Pie Cafe, and then we'll also record as you're watching a version if you're not able to make it. From all of us at Journey Financial Services, we appreciate your time and look forward to continuing the relationship.